Hello, ROI Club members. Today, back with another stock analysis for the September ROI monthly edition. It's a big one. I'm putting a lot of content into this, so I hope you do appreciate it. If you do, please make sure that you subscribe and share with a friend. So, stock analysis, my thoughts on Frontline. The stock has taken off since I started allocating towards it. So I'm going to give my thoughts on that today and what I think might occur towards the end of the year. The commodities market bull market certainly seems to have found its feet once again. Disclaimer, nothing I say here is advice. It's merely my thoughts, and you're responsible for your own due diligence and for your own decision making. I'm merely sharing my opinion, my thoughts with the world. I'm not a qualified financial advisor of any kind. So that's up to you to seek out those appropriate services. So please do not take anything I say as advice. Uh, the publication is sponsored by my premium Substack, which is the Maverick Life. It's about how I generate digital income to give me the freedom of being able to live where I choose, when I choose, with whom I choose, doing what I choose. A big part of that is selling options, so generating income through the sale of options on public stocks. So far, we are averaging over 4% return per month. So that's more of an income generation strategy. So if you're interested in that, please do check out the Maverick Life. Link will be in the description. If you haven't already liked and subscribed to the YouTube channel, I would greatly appreciate you doing that so we can get the word out there and help with the algorithms. So without further ado, the company Frontline, I have mentioned it before on YouTube. This was pre-merger talks. The merger did not go through with Euronav. And given recent events in geopolitics with OPEC cuts and more demand and for refined product, it's made me revisit this thesis. So Frontline is a shipping company involved in transporting crude oil and oil products over the ocean. Okay, so you got crude oil, you got to get it to a refinery, then you got to get that refined product, kerosene, diesel, whatever the case may be, to the end consumer, and that all requires shipping. You can't use two; you got to have, or can't use one vessel for the same same type of vessel for two different products, obviously, and so the difference between a Frontline and DHT, which I've spoken about and has absolutely gone bananas since I mentioned the stock, is that this company also takes the refined product, whereas DHT is purely very large crude oil carriers. So this company is the biggest in class. It's got it's got a fleet of 70 vessels, and it's over $4.5 billion worth of enterprise value. So this is the big fella in the sector, the big player. If we take a look at the ownership, it's no surprise then that it's basically all pension funds and institutional ownership. Frontline, as I'm recording this, $18, and it closed in terms of its stock price. Return on invested capital, 18% over the last 12 months is very, very good for this type of business. And so we're going to take a look at what I think is headed our way in terms of tanker slash carrier stocks, because I also own Cool Company at the moment. So you've got different types of carriers. You've got your VLCC, Suezmax, LR2, and Aframax, Panamax as well. So a type of vessel that can fit through the Panama Canal, through the Suez Canal. You can't necessarily put a VLCC through that bad boy. These are the earnings based on the rates. So Frontline had a record, or the highest profit since 2008. Okay, in terms of its second quarter. $1.04 per share in earnings. So roughly, if you annualize that to $4, it's a little under 25% earnings yield at current price. So very interesting. Dividend, 80 cents a share. That's quarterly. So again, if you were to annualize that, $3.20 dividend over an $18 stock price, yeah, it's not bad. Frontline cash machine. So they do operate different types, whereas DHT is a VLCC. It's difficult to say. Pure play. The company here, if you take a look at its talk to the day rates rising, I've spoken before ad nauseum about how the shipping market appears to be saturated with no new build capacity apart from the LR2 type of carriers. Everything else appears to be pretty much done for the next few years. So it'll be very interesting to see how that plays out. Draw your attention to the graphic on the right, which gives different time charter equivalent rate scenarios. So this is what they can charge. What would happen if VLCCs were at 50K, 75K, and 100K respectively? What that would mean to the free cash flow of this particular company. And then if you look at this kind of green box and diamond here, they've broken it down to an estimate on a per share base. So for Frontline, if we were to see the VLCCs, S-Max, and LR2s at the stated rates here, you'd be looking at $6.34 free cash flow, okay, which is pretty amazing on a stock price of $18. And when you consider, you might think that's a one-off, but when you consider, hang on a minute, apart from the LR2s that I mentioned, we really don't have any more available vessels, and the demand for their product is going to continue to rise. So who knows if we got to 100,000 VLCC rates, that's $8.84 a share in free cash flow. 36% free cash flow yield and above is pretty impressive. In a year, let's remember. So, in less than 3 years, you get your money back on this type of company that has a lot of steel value, okay, or asset value out there on the water. That's pretty interesting to me, anyway. Okay, so apart from LR2, so if I draw your attention down to the bottom here, LR2s, you've got quite a few some on order. So that's vessels coming online in 24, 25, 26, 27. Versus, if I move that little rectangle out of the way, VLCCs, there's basically nothing. It's basically nothing coming online for the next few years. And this is why I was super interested in the DHT trade, because they're a pure play on VLCCs. Suezmax, kind of the same. These bars down the bottom here represent the vessels that will be 20 years or older. And of course, then you need more repairs and maintenance, which means more time offline, which means less available fleet. And then eventually they'll have to be scrapped. I believe it's at 25 years, okay? But don't quote me on that. So Frontline, the big issue with these shippers is dilution and how they're going to use capital. That's always the issue. So they have raised their common stock. If you look at this little baby blue bar on the left, the very first bar, they have increased that over time. However, if you look at what they've been able to do in terms of increasing their PPE and in terms of increasing their revenues, they have been able to do that in a highly cyclical industry that has been in a down cycle over the last few years. If you look at the pink bars here, with some expected fluctuation, they have also done a decent job at increasing their operating income. They haven't been writing themselves bonuses necessarily, at least in the way of SG&A expenses. SG&A expenses for this company are at around 3% of revenues, which is quite good. Here we go. So return on capital and return on equity. The return on equity looks high at the moment because they do have a little bit more debt. But overall, the return on capital has been positive over the last, since 2016, okay, so 6 years. And so for a company that operates a pretty tricky business in the downtime, that's quite an achievement. Okay, Frontline versus its peers. So how are we going to value this thing? What kind of multiples are we going to put on it? I don't really think it's the best way to go in terms of using historic multiples. So where does this company lie compared to its peers? So it's the biggest company by a market cap and enterprise value, as far as I'm aware, in the space. Euronav and Scorpio would be number 2 and 3. If you look at the market cap versus the median, so Frontline, you're paying a little bit more on all fronts there, on in enterprise value to EBITDA, PE, and market cap to free cash versus the median. However, you are also buying the biggest and best in class. And I know there are nuances and differences between the others companies, but the discrepancy between the median and the slight premium you're paying for frontline to me seems very small, very low. Whereas in other sectors, you might be paying ridiculously high for some of the biggest and best in class, like some of the metal producers, the royalty and streaming companies, etc. So it's almost to the case. It's so small a gap. You think, well, why would I pay extra? Excuse me. Why would I take the risk going for a smaller company when there's really not much difference in terms of how much extra I'm paying as a premium in terms of multiples? The reason I've allocated more heavily towards DHT is not due to that. It's more due to the fact that DHT is a pure play on crude carriers and VLCCs. Okie doke. So price at $18, and we've got the end of this year's estimate for EBITDA earnings and free cash per share using your median multiples. Okay, at the moment, you could easily get a multiple advancement on this. It's just a quick back of the envelope summary. So, $18, equally weighted price target around $20.40, and you're getting a double-digit dividend yield. Now, if you were to get a multiple re-rating here, and you were to pay maybe 10x and 8x respectively for the earnings and free cash flow, so you have a 12.5% earnings yield, 10% free cash yield, then obviously you'd expect a significant upside. And if their day rates hit and they're producing $8, $8.80 per share in free cash, 5/8 of 40, that could be double what I've placed here quite easily. So there's quite a bit of potential upside and torque to movements in the day rates for this stock. If we look at the sustainability of the dividend, their liquidity is quite good, and they've been able to continue. They've got an average dividend yield over the last 6 years of 9.1%, which, as I mentioned, considering the nature of the business, is really not too bad at all. That's that. So hope you enjoyed that. Please do like and subscribe to the YouTube channel, and make sure you check out the Maverick Life subscription. Link will be obviously available in the publication. Otherwise, make sure you take care, guys. Do your own due diligence, and I look forward to seeing you in another video shortly. Cheers.